Hi there, traders, and welcome to Trade the Structure. Now, what I'm going to go through is a setup that I affectionately term the three candle setup. Okay, it's something that I use regularly, and if I do see it, I'm obliged to actually trade it. Okay, it's got a bit of criteria to make sure that you're on the right side or it's got the right structure to the setup. But once it actually plays out, it can be really powerful. It's a really powerful tool to make sure that you're getting in the right time. You're getting in when the market's going to expand in your favor, whether it's down or up, like in the examples there, and you're getting on the right side of the action. So the criteria that I base it around is I've got a 10 EMA and a 20 EMA, okay, upside and downside. If I'm trying to go short, if I'm looking for the setup on the short side, I essentially want the action to be below the EMAs and I want the 10 to be below the 20, okay, and vice versa to go long. And what we're really looking for is if I ideally trade this off the 1 minute time frame. Okay, it's nice and fast, but what you'll see is you'll need the 5 minute time frame to be in the downtrend, and then you get these little pops when you get on the 1 minute. It could pop if it's a nice strong trend. What you'll get is three candle setup, and then bang, it'll continue its way down. If it's a choppy market, you don't tend to get these setups. It's more when it's a nice strong market, when you're on the right side of the action, the market starts to head south, has this little minor pullback. Those three candles will start to set up. They'll play out nicely. You'll hit the MAs and then it'll come straight back down again. Essentially what I'm looking for is that move down, then you get one candle that might be an inside candle, more or less the body of the market. I don't mind if it wicks out, because a lot of the time it can actually push through the previous high, wick through, but come back below. But essentially you want the body inside the previous candle. And then the following candle to be continuation of the trend. Okay, so it might have touched the MA here. And like you can see in this example here, it's just wicked through the previous candle just to take some liquidity out of the market. And it's come straight back down. And I'm essentially looking for an entry through that break of the low of the first candle. You've got those one, you got with the trend. Two is that minor reversal, and three, it continues with the trend, and you're just trying to take the break of number one, and you just set your stop just above, or you can have a set stop. That's the setup on the short side. Now for the long side, we're looking for the reverse. Okay, action's got to be above the MAs, the 10 and the 20. The 10 above the 20, you want the action above, a bit of a push off the MAs, this minor pullback. It's showing a tad of weakness just to drag in some sellers, maybe to squeeze some buyers out. You got the first candle's green. Second candle is going to have a little reversal. It's an inside candle of number one. And then the third candle basically takes out the high. Now, if it does flush a bit lower, that's great because you know that there's stops going to be below that level. It's going to search for liquidity and it turns around and quickly reverses straight back up, shows the strength, and you're jumping in on the break of that high of one. So that's the setup. Let's whip through now and go through some examples. So this is the actual action for today. We're on a 1 minute chart of the Hang Seng. So we'll go from left to right. We can see we're above the action here. You can see there's actually a three candle setup there, but it's on the wrong side. So you're not really wanting to go short there because it doesn't fit our criteria. So if we just keep heading across to the right-hand side, what we can see is the market pushes down so that the action within that candle is below the MAs. The 10 is not exactly below the 50, but you can see it's about to cross over. The very next candle, it spikes up, it flushes through the high of the previous candle. It even takes out the couple of highs before the body settles and finishes within the previous candle. So the very next candle after that, the third candle of the setup, you can see the MA is just starting to cross there. They probably are crossed, right teetering, but either way, it's a nice little setup and you can take the break. If we just mark that up, that's basically our setup there. You could risk well above those highs, but then you've got a higher risk reward trade, as in you've got a one-to-one potentially. But if you use a 40-point risk like I do, that was somewhere around at the break of that low, 40 points take you somewhere mid-range up here, but it's still got played out nicely. Keep going across the right-hand side. You could be looking at that. It's not really a three candle setup. It's not exactly like I like to see. I mean, it's not far from it. You could have taken the break of that low there, but it's not exactly falls within the criteria. So if we keep going across to the right-hand side, MAs are still down. MAs are still in place. Here, we end up above the MAs. So let's keep going across to the right-hand side, filtering through. Three candles here, there's a little red candle there, but we're on the wrong side there again. On the wrong side still here. Okay, up to about here. If we start looking at this, okay, I like this. It's a bit of a variation, but what you're seeing is the market push up. Okay, what it's doing is taking some liquidity out of the market from sellers. Sellers are going down, they get squeezed out, it pops back up, and then the very next candle, once it pops above the MAs, it reverses. So you've got your first candle essentially is that green candle. Your second candle is red, it reverses that trend. It's going back in the way of the trend. The trend is starting to roll over and head south. And then we just take the break of that initial green candle and you've got a nice little setup there. Okay, it's a bit of a different type of setup, but essentially that price action was below the MAs. It spikes above, straight back down again. So when we're actually trading, we're still below the MAs. We're still with momentum and we've got a nice little risk reward trade. Now, if that doesn't play out, your risk is above, so be it. But it did, it played out quite nicely. And then we just followed on from there. We just manage our risk as we go. Now, if we go across to something else on the Dow, okay, I'm finding the Dow is not as common, but you can get some really powerful setups. And I'll show you one, if you could probably see it right in the middle of the screen there, that led to a really nice rally, okay? And you can see by the risk reward, using that 3 candle setup pattern, the risk reward can be really high, okay? So you're not risking much to pay out 2, 3, 4 to 1. It can be a lot more than that sometimes, okay? So if we just go just in this section here, what you'll see, the market's popped up, it's pulled back to the MAs, started to lift again, okay? We're back above the MAs here on this candle. That little red candle there, it pulled back to the MAs, it touched on the 10, and the 20, and then the very next candle, it started to lift off. So if you're looking at that pattern just in here, you know exactly where your risk is. You're taking the break of that initial green candle there. You've got the little one red candle, so you've got basically 1, 2, 3, nice strong move. It starts to lift off and then really just starts to take off as it clears the previous lower high. So that there is a prime setup. What you're doing, it enables you in 2 things. When it sets up and it plays out well, it means it's a strong market. And secondly, you're not taking too much risk on that trade at all. So if you are wrong, okay, so be it, and you get stopped into the trade, your risk is below, it might flush in and come straight back down. It can happen, okay? It just means that you're wrong. It's as simple as that. But when it does play out, it's worth the risk. Let's get over to the Nikkei. We've got 2 I'm just going to show you. The first one's a little bit debatable, but it worked out quite well. It adds up, the criteria adds up, but there's just that minor, the 10 being above the 20. It was there, you know, it's debatable whether it was in place or not. But the second one actually played out quite nicely, and you've got a good little risk reward trade on that. So it's more about the setup itself is more about the risk reward than how many points you're going to gain. Because if you're risking only 5 and you're getting 3 to 1, as opposed to your normal risk might be 20, you could put more dollar value to that risk. Okay, so if you're just risking $300 each trade, when you're risking only 5 points, you're doing a lot more dollars per point. So the first one you'll see just at the bottom of the screen, the market was heading down, you know, holding below the MAs. Then we started to get a little spike above the MAs. Okay, spiked above. You got this first candle. That's the first in the series of the 3. Okay, green straight above the MAs. The secondary candle flushed down. It touched the low, might have tipped through a point or so, but basically the body is within the recent wick of number 1, the first candle. That's your first candle there. And then you've got the third candle. It just broke the high. The MAs were about to cross. The very next candle they crossed anyway. So what you're looking at, that's your entry. You can have your risk below. If that's too large, you can use whatever risk you like. But you know that once it starts to kick off, if you get into the trade, and it does kick off, you're on the right side of the action. You know the market's going to be quite strong. And if it's not, again, you're not risking too much. Now get on to the second one. I'll just mark it up. So you can see the market's powered up. It's tried to go down, and then you got that expansion. You know, we're chopping around that 10 EMA, and then we get above that very next pullback for the red candle, just in here. It didn't go too far before we got the third in the series of the setup, and it broke to the high, and then up we go. So everything's in place. We're above the EMAs, the 10's above the 20 EMA, and we've got our 3 candles. We bought the break of the first candle, and then up we go. Okay, so that's pretty much a couple of good examples on the 3 candle setup. It's a really handy setup to have in your repertoire because, like I said, 2 things. It minimizes your risk on any one trade, and you're going to get in if it does kick off and it does start to play out. It means what direction you're trading in is quite strong, okay? The majority of the participants trading are on that side. So if it's a long, it means they're all bullish. Or if it's a sell, they're all bearish, okay? Rather than have that 50-50 ratio where the markets get choppy and range bound, it's quite a good little setup to get that expansionary phase. You're getting in the right zone for that expansionary phase, and the payouts can be quite nice. So hopefully you enjoyed that. Hopefully it made sense. If you have any questions, just send us an email to tradethestructure@gmail.com. And it'd be much appreciated if you leave us a like and give us a thumbs up. And if you haven't subscribed to our YouTube channel, please do. Cheers, guys. We'll speak to you again soon.